Now we understand the requirements, and it looks so exciting. You should be looking forward to read the question now, and this is how you should approach your exams. The way to do well is please go look at the requirement first. It will raise your curiosity and makes you look forward to reading the story, because it's actually a story, an interesting story. Every exam question is an interesting story. Yeah. So let's look at this nice story. So I believe you've all gone through this quickly. So when I just breeze through the question, it should be easy for you to follow through. Yeah. So you have Chikepe, who market value of equity. So I'm just going to start listing those things. So market value of Chikepe. Of equity. Please pay attention. Yeah. Not market value of Chikepe. Market value of equity of Chikepe. Market value of a company is totally different from the market value of the equity. Market value of equity is the market value to the shareholders, whereas the market value of the company is the value to all the capital providers. And you already know a capital provider is either an equity provider or debt provider. So when you have both of them, we are talking about the market value of the company. But if it's shareholders, then that is market value of equity. Thank you. Yeah, so they gave us that to be 12,600 million. Yeah, so let's just note that down, because all the important information, you need to note it down. Yeah, the debt equity ratio was given as well, 30/70. We have that is still talking about that is talking about Chikepe. The company developed that's we don't send out that. So there's a recent meeting, where they are looking at company need to change its current strategy of growing organically. So they've been growing organically. Now they want to consider acquisition. Yeah. What are the benefits of acquisition over organic growth? Quickly. Remember, I'm not just going to focus on just answering this question alone. I'm just also going to use it to do a bit of revision on some of the concepts that I can see quickly. What are the benefits of growing through acquisition over organic growth?
You'll grow at a faster rate.
Faster rate, fantastic. Faster rate. That's one of the biggest advantages. What else?
Help new R&D to add to your existing stock.
Yeah, fantastic. You might be able to actually get some additional synergy that you won't have internally, and that might involve you getting some R&D benefit or some product pipelines or even capacity that you don't have. Yeah, expertise that you don't have entirely. Nice. So they want to do that. They want to acquire. They want to stop growing organically. Now look at these directors. This is where that start getting interesting, because remember the first question actually want us to discuss what director A and director B are talking about, right? So now let's look at what they're talking about. So director A was of the opinion that Chikepe should follow a strategy of acquiring companies in different business sectors. She suggested that focusing on just the pharmaceutical sector was too risky, and acquiring companies in different business sectors would reduce the risk. So this risk management, yes, that's what they are talking about, Director A. What approach of risk management is Director A talking about? Here you'll be discussing diversification. So already we have that idea. That's what A is talking about. What about Director B? Let's look at what Director B is talking about. Director B was the opinion that Director A's suggestion would not result in a reduction in risk of shareholders. In fact, it suggested that this would result in agency-related issues, which Chikepe could shareholders reacting negatively, and as a result, the company's share price will fall. Instead, B suggested that Chikepe should focus on its current business and acquire other established pharmaceutical companies. In this way, the company will gain synergy benefits and thereby increase value of its shareholders. What is Director B alluding to?
Oh, this is horizontal expansion, right?
Fantastic. That is horizontal integration. Thank you very much. Smile. And you can see as long as the question is looking, it's not looking even too easy already. Those are the two things you want to discuss to earn 7 marks. Now, what do we need to say? There's no more that we need to pick from A and B. These are the two things we need to talk about. So once you have been able to identify this, remember, you're a professional student, you're a strategic paper writer. So you don't just write in a scattered manner. You have to write properly and in a structured way. Even your thinking has to be structured. And that's how you're going to earn all your marks. So you've identified the method. So that would be your starting point to say Director A is talking about diversification. And once you mention diversification, the next thing you need to do is you put a definition. What is diversification? What does it mean to diversify? So when you are diversifying, all you are doing is just investing in different sectors to reduce your risk. Yeah, so your portfolio is not concentrated. Those are the things you'll be saying. Yeah, so definition, you deal with it, which is talking about what it is. Then once you've dealt with definition, then you need to check for appropriateness. Yeah, so you're talking of appropriateness of method. So you need to be thinking, how do I structure my response? You don't just write, like, I just want to write. No. Appropriate. When is it appropriate? When is diversification appropriate? You need to talk about it. Because when you know when it's appropriate, then you can now go to the next step, which is about relevance to your case. So when is diversification appropriate? Remember, we said this is only appropriate when shareholders or investors, let me put investors, are exposed to what type of risk? Systematic or unsystematic risk? Unsystematic, actually. Remember, systematic risk, you cannot diversify. Yeah, that is your business. That is not your business risk. That is, you remember now, yeah. That's your beta. That's why you get rewarded for systematic risk with your beta. But unsystematic risk is your concentration risk. So you only use diversification when investors are exposed to unsystematic risk. That is, they have concentrated portfolio. Now, remember, I'm not going to be writing all stories in this class because if I have to do that, I'm not going to solve even one question in 4 hours. So I'm giving you all the key points. What I expect you to do after this class again is for you to sit down and do a write-up properly based on those key things that I'm mentioning here, right? So you know when it is suitable now. Concentrated portfolio, exposure to systematic risk, yeah, then diversification would make sense. Now, looking at this case, can someone tell me, would this be relevant to this guy? The shareholders of the Chikepe, would diversification help them? If you look at the question, do you think that's a problem for them? So now let's look at who would diversification actually benefit? Remember, the diversification is not for the company, but rather for the shareholders. Shareholders are the company. They are the owner of the company. So they already have this pharmaceutical company. The question is, should they diversify, which means should this company invest in a different company so that the shareholders can benefit? How do you decide on this? You need to, first of all, understand the nature of the shareholders that we're talking about. Yeah. And if you look at the nature of the shareholders, they clearly told us, they said Chikepe is a large listed company operating in the pharmaceutical industry. That is Chikepe. But what about the shareholders of Chikepe? They said institutional investors hold most of its equity shares. So which means that the owners of Chikepe are institutional investors. And what does this mean? This makes a lot of difference. The fact that they are institutional investors. And what it means is that these are really professionals in the investment space. These are experts. These are experienced people. You never will expect these institutional investors to hold concentrated portfolio. Never. Even high will not hold a concentrated portfolio, though individuals can hold because some individuals might not even have the knowledge because they are just investing. But when you're talking about institutional investors, the least thing that you expect them to do is to have a diversified portfolio. So, because the owners, the shareholders are institutional investors, you expect them to hold diversified portfolio already. So Chikepe will just be one out of thousands of investments that they are dealing with. And in that case, please, diversification will not help. Diversification will not be expected to give so much value. So when you are writing, don't be definite. Like I always tell you, don't be definitive. Just try and use might. Don't be very certain when you write. So diversification might not yield so much benefit. The same way that I've dealt with diversification, I'm going to talk about horizontal integration as well. Yeah, which means I'm going to bring these three down as well. What's horizontal integration? M&A between companies with similar operations. When is it appropriate for companies to use? When do you think a company should pursue this strategy? Right, so this is appropriate when companies are targeting synergy. Yeah, and that synergy can be either cost synergy, can be revenue, can be financial. Yeah, with minimal risk. Yeah, usually when you go into within, your business area, sort of, you're trying to also want to minimize the risk of failure because it's an environment, it's an industry that you're already familiar with, it's an operation you are familiar with. All you are just looking for is synergy. Yeah. So for this case, is this something that will be relevant? Is this something that you think might be good for Chikepe? Definitely relevant by all means. It's the way to go because there's a lot of benefits. And if you look at the question even asks us to list out those benefits. I'm just showing you that you don't just go straight and listen the benefit. You need to have that discussion that I've just mentioned. Yeah. Before you go into look at the question said, discuss A and B and the types of benefit which may arise from the acquisition. So a lot of benefits, and we need to list some of those benefits.
They'll be able to gain pricing power.
So pricing power might increase. Okay.
Eliminate competition.
Might increase. I'll make that because of reduced competition. Because they are in the same operation. Fantastic. One. What else? At least you should be able to mention 3 or 4.
I would also say that we can share skills and work together.
Fantastic. Anytime, in fact, that's the first thing that must always come to your mind anytime you see horizontal integration. Economies of scale will always be there because we are in the same operation. Why do we need to have the same finance division? Why do we need to have two admin? Why do we have to have two legal departments? We can merge all of that together and fire some people and get some savings on admin. And likewise, if we are using the same system, the same process, the same raw materials, it means that we're going to be order raw material that's almost double of what we used to order. And if that is the case, to negotiate more bulk purchase discount. Yeah. We can also reduce departmental sizes. Yeah. Merge department and all of that. And you get economies of scale from that because it's the same process. We don't need new skills. We don't need new raw materials. It's just same thing. Okay. What else? What are benefits? There was one I showed you now. The fact that these guys have fewer products and those other ones are growing faster. It means that there's a leverage there, which is the opportunity for products. Opportunity to increase products output. Yeah. And likewise, even the foreshore can get, remember, it's synergy funding. Yeah. Because it's good to be able to pick your response that are quite relevant to the case as well. Remember, you're not going to write in bullet points like this. I'm just putting the key points you need to put in your write-up for you. So take, for instance, what you can write for an example can be something like, the Director A discussion is centered around a method of managing risk called diversification. Diversification involves investment in different sectors to reduce the risk exposure. Whereas Director B is looking at horizontal integration, which requires mergers and acquisition between companies with similar operations. Looking at Director A, diversification is only appropriate if investors are exposed to unsystematic risk, that is, investors are holding portfolios that are concentrated in one sector. However, looking at this case of Chikepe or Chikapa, their shareholders are mainly institutional investors, which are expected to understand investment strategy. At a minimum, these investors would have managed their concentration risks by diversification on their own, and Chikepe would not have to diversify to help them reduce their investment risk exposure. That is how you're going to be writing. Discuss how using real options methodology in conjunction with the net present value could help establish a more accurate estimate of potential value of companies as suggested by Director C. So let's look at Director C. What is Director C talking about? Director C agreed with Director B, but suggested that Chikepe Co. should consider relatively new pharmaceutical companies, new ones. I don't know why, but we'll find out. As well as established businesses. Okay, likewise, established ones. In our opinion, newer companies might be involved in research and development of innovative products, which could have high potential in the future. She suggested that using real options methodology with traditional investment appraisal methods such as NPV could help establish a more accurate estimate of the potential value of such companies. So this one is just the methodology that considers flexibility. Let me not repeat option again. Remember, I always tell you, option just means flexibility in project. Yeah. So, and you should give some examples of those flexibilities. You can have a delay option. You can have expansion option to expand or to even abandon. Right. All of this comes with a value, and that's what option methodology does for you. So option methodology values this. So it values the flexibility. Yeah, which is what you won't find under the traditional method. Yeah, if I put traditional method here, your traditional NPV and option methodology here. That's what you want to discuss. Yeah. Real option methodology will consider flexibility in projects. This one does not. Yeah, so it values those flexibility, and the total value of project is the NPV plus the options, plus the option value. Yeah. So invariably what we're saying is that this one ignores flexibility, because your normal NPV will just do your cash flows, plot the cash flows and calculate NPV. If it is negative, don't do it. If it's positive, do it. Sometimes NPV can be negative, but by the time you add the option value to it, the total value becomes positive, and that's a good investment. So you can actually lose a good investment if you focus on traditional NPV alone. Yeah. So what we're saying is that this consider both intrinsic, that's the normal NPV, intrinsic, and the time value. Whereas your NPV alone is just looking at intrinsic value. Yeah. So, which means you have a full value. Like I said, this is a full value. And this is, if you use this method, is rather partial, not full value, because it's only looking at intrinsic value. Yeah. So in terms of decision, which one will give a better decision? Better, yeah, because that consider full value. But this one, no. So this is better, but this is not, because it assumes investment decision is always taken on now or never basis. It doesn't understand flexibility. Yeah, it just believes that once you decide to do an investment, just start computing the cash flows. And if you don't want to do it, don't bother. If you want to do it, do the cash flow. Whereas that's not the reality. Sometimes you want to do an investment, but you have that flexibility to say, I will not do it now, I'll do it in 5 years' time. Or I will do it now, but I can expand it again in 5 years' time. When you do your traditional method, all the cash flows are just discounted as if they are rigid, no flexibility. And that's why your real option methodology is usually the better. And that is the comparison that they want you to discuss in B. All these points must come out. And remember, you need to write. Please don't do a table like this. You need to write, and write on your Word document. One thing you need to note on this paper is do calculation on Excel, do write-ups on your Word document. If you have calculations you need to reference on Excel, label your calculation on Excel appendix 1, 2, 3 like that, so that when you are writing on Word document, you can make reference to those calculations. I mean, A and B, we've not done any calculations, 12 marks already gone. Now, C is where calculation will start. As you can see now, C, they want us to do a report. Yeah. What I'm going to do with this quickly is to give you a template, which I always talk about, yeah, for your report. And it's important you use that template. And I will also advise you, please write a report. And not just report. In fact, all the questions I'm going to be solving today, make sure you go and solve them on your own after and write it fully. Yeah. Share it with someone. You have a partner you're studying with, share it with each other and mark each other as to what you think, yeah, on those response. I want to believe you've seen that the question is not as difficult as it looks. And I go into C now. Prepare a report. Now we want to do a report. please note that anytime you are preparing a report in this paper, there are some titles that must be present in your report. The first one is your title, the title itself of the report. That's number one you must have. You must have a title in your report. You must have introduction paragraph. Introduction or background, you can call it whatever you want to call it. You must have that. You must have results. Extremely important. Once you have results, the next thing is to have conclusion. And I'm leaving some spaces before I put conclusion. And I'll tell you why again. Does anybody remember why I'm leaving this before I put conclusion?
Because we are going to be discussing other factors.
Fantastic. That are specifically requested by the question. Those are the things that will form other paragraphs. But these four, you must always have it. The other ones depends on what the question is asking for. You can see that this question here is asking for three specific things. Prepare a report for this, with this estimate, with this and that. 1, 2, 3. So C1 is just estimate, which is just calculation. Yeah, so that definitely I can cover in my results. Estimate of the equity value arising from combination of foreshore with Chikepe. Equity value arising, yeah. So that's also results, just figure. I can cover it in my results and reference my appendix for calculation. So I don't need new paragraph. It's not a discussion. But look at these three. This is a discussion. Evaluate whether the acquisition of foreshore will be beneficial to Chikepe's shareholders. So there's a discussion I have to do. So assessment of the acquisition, that will be a paragraph for me, for sure. And discuss the limitations of the valuation method. Then I have limitations of valuation method. So I know. So before you start writing, please make sure you know your structure. So I can't start writing until I know these are my 5 paragraphs with title that I want to write. So, and what is the title? The title is always in the question. Prepare a report for the board of directors of Chikepe. So my title can easily just be report to the board of director of Chikepe on acquisition or on potential acquisition.
Right?
So introduction paragraph, what are you going to be saying in introduction paragraph? Very straightforward, very easy. All you need to do here is just state what's the content of the report. So let me just say, to keep it simple, focus on the contents of the report. And what is the content of the report here? What you're saying is that this report then covers what? Or discusses, whatever you want to use. What is it discussing? The value of equity of foreshore, the value arising from combining foreshore and Chikepe. Also, it's going to look at limitations for valuation method and also the acquisition benefits to Chikepe. That is what the report covers, and that is what you're going to be talking about on introduction. Simple. Results. What is result? Result are your calculations. That's what you're focusing on there. Calculations, then maybe if you have some justifications, maybe some explanations, you can add it. Yes, before you now go into other part of the paragraph. So We've dealt with these two, the title, the introduction. I've told you what that is going to be all about. Now let's look at the result. So which means here the result, we need to cover the equity value. So we need to calculate it because that is something specifically requested for. So we need to calculate the equity value of Forshaw. That is C1. Then equity value of combined entity. Yeah, we need to calculate that in our results. So let's look at the first one. What I would do is, so we'll start our appendix. This is the time you go to Excel and the first one, you know your calculation is beginning, so that's your appendix 1. This one, we can call it appendix 2. So for appendix 1, we want to try and determine the market value of equity of Forshaw. Very important that we're able to break that down. And what information do we need? They gave us information about Forshaw here. Yeah, this is Forshaw. What approach do you think we need to adopt to be able to get the value of Forshaw? What valuation method do we need to use?
Free cash flows.
Free cash flow, thank you. Appendix 1, all your appendix must have a title, well labeled. So the focus on appendix 1 is equity value of Forshaw. Cool. So you could see it's labeled. Yeah, an approach, we have said we're going to use free cash flow method. So which means this approach requires us to be able to determine the free cash flow from Forshaw. When we know that free cash flow from Forshaw, then all we have to do is to discount it with the cost of capital of Forshaw, and we will have the present value, which is the value of the firm. And in the beginning of this class, we all agree that the free cash flow from the firm will only give us value of the firm. But if we want to get the value of the equity, then we need to take out the debt. We all agreed and we understood that. Now let's look at the information we have. Forshaw Co. is a non-listed pharmaceutical company established 10 years ago. Initially, it grew rapidly until money was taken out of it, then it started struggling. The current debt equity ratio 60-40. This high level of gearing means that the company will find it difficult to obtain funds to develop its innovative product in the future. They gave us financial information, current revenue, profit before interest and tax, interest, tax, and profit after tax. We are not interested in profit after tax. What we are interested in is free cash flow. In arriving at the profit before interest and tax, Forshaw Co. deducted tax, allowable depreciation, and other non-cash expenses, totaling $112 million. It requires a cash investment of this amount in non-current assets and working capital to continue its operations at the current level. 3 years ago, Forshaw Co.'s profit after tax was 83.3. That was 3 years ago. Now it's 91. Not doing badly. Maybe not just growing as fast as we expect. And this has been growing steadily to their current level. Forshaw Co.'s profit before interest and tax and its cash flows grew at the same growth rate as well. So which means The growth rate from 83 of profit after tax to 91 is the same growth rate you expect the profit before interest and tax and the cash flows to grow. And this growth rate will continue for the foreseeable future if Foreshore Co. is not acquired by Chikepe. They gave us the cost of capital of Foreshore Co. at 10%. So which means all we have to do here is to estimate the Foreshore Co.'s cash flows for the future. Remember, valuation is done based on your potential, not on what you already have. Like I always say it, your value is what you can earn in the future, not what you have already earned. Your value is the present value of all the future cash flows. So which means we must be able to estimate all the future cash flows of Foreshore from next year till the end of life. Interestingly, Foreshore does not have a death certificate. We don't know when it's going to die. They said it's going to grow for foreseeable future. So you already know that in valuation, there are two periods that you must know. The planning horizon and beyond that. Beyond that can be definitive or can be infinitive. In this case, beyond is perpetual for this guy. So it's forever. Let's look at the plan horizon is when you expect your revenue to grow. Yeah, before it becomes steady. But the interesting part is for this guy, he doesn't even have planning. So it's just steady growth forever. So this is pretty easy for us. Yeah, but for this guy, they told us that right from the following year to eternity, it's just going to grow at a steady rate. And that rate will be the same rate the profit grew 3 years ago to now. So which means our dividend valuation model comes handy here. And what is that formula? That formula told us that all we need to do is to get the current cash flow. Yeah. Then you multiply it by 1 plus G. Then you divide that by the cost of capital minus G. I'm sure you remember this dividend valuation model. It's the same thing. Instead of using dividend O, we're just using cash flow O. So cash flow O is our free cash flow, current free cash flow, which we need to use this data to determine. So how do we calculate our free cash flow, our current free cash flow? You always have to start with the PBIT, remember? Profit before interest and tax. That is usually your starting point. Profit before interest and tax is given to be 192.3. Please, another thing you need to note here is that your taxes for valuation is on PBIT because don't think you're going to pay tax on profit before tax because remember you are doing a valuation of the firm. So you don't want any financing information. I always say it, all financing data out of it because you are valuing the whole company as it belongs to the capital providers. Yeah. So, tax, they already told us tax is at 20%. So we know we're going to deduct that tax. Also, we need to deduct non-cash flow items or adjust, let me call it adjust because it might be deduct, might be add. So adjust for non-cash flow items. And the popular non-cash flow items that we always deal with is what? Depreciation and all of that. Yeah. But here, they told us, they said he has deducted depreciation and other non-cash expenses, totaling 112. What do we do to that? Do we add or we deduct?
Add.
Thank you. We add. Then working capital adjustment. Interestingly, because normally you do working capital before you go to the investing. Yeah, but they already merged it for us here as well. And they said there's a cash investment of 98 that needs to be done. in order to continue its operation at the current level. So every year, we're expecting to do. So I'm going to go to investing now, activity. Please ask questions if you have any. Non-current asset and working capital. Do we deduct or we add this 98.2?
This is going to
We
be
deduct.
deducted.
Exactly, deducted, because we are actually investing. So we are spending money. Any other cash flow item? No, because once we are looking at free cash flow to firm, it's about operations and investing. Financing is not relevant. So, okay. So we know our free cash flow for current year. Now, this guy will help us out now to get our value for the company. Okay, we don't have growth rates. Our growth rate, we need to determine the growth rates. What method do we use for growth rates? Do we use Gordon or average method? The information that we have, which method will be relevant? Remember, they told us
I
that. Right.
think average method, since we have present value and future value.
Okay. Because they've given us two values. The oldest value, which is 8.33 profit after tax, and the current value 91. It's not that you always have to use profit. It's because the question has already told us that the rate at which the profit is growing is the same rate that the cash flow will grow. Yeah, they've told us. See, it's cash will grow at the same growth rate as well. They've told us. So that's why we'll need to leverage on the way profit has grown 3 years ago to 91 now. And whatever growth rate that is the same growth rate that our cash will be expected to go. And it's the same formula. If you struggle to remember the formula, try and remember this formula. Future value is equals to present value into bracket 1 plus R raised to power n. That's the same formula. This formula is very good formula. You can't joke with this formula. All you need to think about is future value is always the most recent value. Present value is the very old value. Sorry. Yeah, present value is the old value. R is your growth rate that you're trying to get. So I'm going to change this to G now. And N is the number of years of growth. And that's why this is the formula you're always using for your growth rate. So if I put all of that here, then I can easily know that my most recent cash flow is 91. I'm going to divide by the oldest, which is 3.3. 3.3. Then all of that raised to power 1 over 3. And I need to deduct all of that minus 1. I can get
Why isn't 3? Because the question says 3 years ago, right?
Yeah, 3 years ago. Because 3 years ago means it must have grown 3 times. So what year will be 3 years ago? Let's say we're in 2025. 3 years ago is 2022. So it would have grown to 2023, 1 growth, 2024, 2, then 2025, 3. Right. So that's 3 growth. So 3 times. And that's why we're using 3 in this as n. So we know our growth rates, then we can easily now apply this formula. So let's try it. So free cash flow, current free cash flow is this guy. We have to multiply by 1 plus G. 1 plus G is this guy. Then all of that divided by cost of capital minus G. Sandwich them in brackets. Yes, thank you. You guys are spot on. So now we know the value, but that's the firm value. That is the value of Foreshore. But what is the market value of its equity? What is equity value? They already told us that this company called Foreshore has debt equity ratio of 60-40. So which means debt is 60%, equity is 40%. So that is equals to 40% of that total firm value. So we know the equity value of Foreshore. Okay, so we know the equity value of Foreshore, so which is what we will need in our result. Likewise, the other thing we need in our result, which we have identified, is the value of the combined company. So I can call that Appendix 2. Appendix 2 is the value, in fact, equity value. See, so I don't get it twisted. Equity value of the combined entities. That is the next thing that we need to do. Because we look at the question, that is C2. Estimate the equity value arising from the combining Foreshore. And if you look at the information we have as well, the information we have requires us to, this is the information on the combined company. Yeah, let me just go through it quickly with you. I know you read it. So once this action takes place, it is predicted that the combined company's sales revenue will be 4,200 in the first year, and its operating profit margin always be 20%. After the first year, the sales revenue is expected to grow at 7% per year for the following 3 years. Now, you'll see different types of horizon here now. That's the planning horizon you are just saying. It is anticipated that after the first 4 years, the growth rate of the combined company free cash flows will be 5.6 per year. You can see, similar to what I just explained to you not long ago. What they are saying now is the first 3 years, they grow like this. Yeah, 7%, this growth. But after 3 years, so this is 3 years, it will be growing. But what happens after 3 years? It will still grow, but at a different rate, slower rate, which is now 5.6%. But this is 7%. The combined company's tax allowable depreciation is expected to be equivalent to the amount of investment needed to maintain the current level of operations. Rotimi. You can see for the combined entity, the scenario is different. However, as the company's sales revenue increases over the 4-year period, the combined company will require an additional investment in assets of $200 million in the first year, and then 0.64 per year increase in sales revenue for the next 3 years. So they gave us the expansion cost here. So there will be an expansion cost here. That's what we've seen here. It can be assumed that the asset beta of the combined company is the weighted average of the individual company's asset beta, weighted in proportion of the individual company's values equity. This is extremely important to note because usually it's a popular way to weight asset beta using the firm value, the total value of the company. But now the question is telling you specifically how you should weight your asset beta of the combined company. You know, when two companies come together, you cannot just say the asset beta of the combined company is the addition of the two. No, that would be wrong. And you can't take one of them as well. That would be wrong as well. You have to weight it. Yeah, and they've told us how to weight it. Weighting is just similar to calculating proportion and multiplying by each other and adding together. Just the same similar weighting you do for work, right? I will do that with you, no worries. So that will give us the beta asset of the combined entity. And it can also be assumed that the capital structure of the combined company remains at Chikepe's current capital structure, which is 30/70. So the capital structure remains 30/70. Chikepe will pay interest on 5.3% per year, so that's cost of capital when they combine. Now let's look at the combined entity. We've seen the revenue, they've given us the information, the growth of the revenue has been given as well. So we can actually start to plot year one. Yeah, 3 years, that will be growth for 3 years. So revenue for year one is 4,200. And this will go at, it will grow at 7% for 3 years. 1, 2, 3. Yeah, so that means that will grow to year 4. Yeah, this is another tricky one. Don't think because they said it will grow for 3 years, then it will stop at year 3. These examiners, they always have a way to get you rattled.
How do we determine that?
Okay, so the question said at the first year, it is predicted that the combined company's sales revenue will be 4,200 in the first year. So you are definitely sure that year one revenue is 4,200, right? That one is clear. Then they now say after the first year, that is from here, the sales revenue is expected to grow at 7% for the following 3 years. If 3 years are following year one, when would that stop? That is the first
Oh,
growth. Second.
yeah,
So
yeah.
exactly. So those tricky things, please pay attention. And I mean, I can't solve many questions, but the few I can solve, you will see that you need to be careful and pay attention. I will tell you a few things that will help you in other questions you try to solve. But definitely, please, you have to be careful. Don't rush,
Okay.
even when it appears easy. Don't rush.
Okay. Thank you.
Good. So it is anticipated that after these first 4 years, now this corroborated that, luckily. So this can confirm your understanding. The growth rates of the combined company's free cash flow will be 5.6 per year. So after this, so we already know that this is actually 4 years, actually the planning horizon. Then after that, everything goes at 5.6%. So, but let's deal with the first 4 years that we have. They told us that the combined company's tax liability position is expected to be equivalent to this. Okay, that's fine. So note this, we need to take care of this. Rotimi and all the questions I've been trying to answer, I think this will address it. However, as the company's sales revenue increases over the 4-year period, the combined company will require an additional investment in the first year, and then 0.64 per $1 increase in sales revenue. Okay, so we need to get our tax, we need to get our depreciation and all of that. But remember what I always tell you, for cash flow, please make sure your tax is on profit before interest and tax, right? Not on profit before tax alone. But what's our PBIT? They told us that operating profit margin is at 20%, so we can get out easily 0.2 times this. So we have our PBIT. And that is what we're going to pay tax on at 20%. So we know our tax. Now, I want to speak on this statement on the tax allowable depreciation being the same as the current level of operations. If you look at this, to adjust for your depreciation, what you normally have done is to say, okay, add back depreciation, yeah, which we don't have the figure of depreciation of. But whatever the depreciation is, if you add it here, because it's going to maintain investment, you add it back here. What do you do when you get to investment activity? You deduct it. What is the impact? Exactly, 0. So it's not just interesting that they didn't give us the figure, but rather we also know that we don't need it because it's going to be in and out. So even if you say you want to assume a figure for your depreciation, you're going to add it here, then you deduct it again later. Still doesn't make any impact. So you still don't earn any mark with that. But another thing I'm going to mention to you in this paper, please don't be locked down that you want to just calculate a figure. If you are running out of time, you can assume a figure to move on with your analysis. Even if you don't have any basis for the calculation, you can say assume the value of the combined entity is so amount and continue with whatever you can do. You will hand mark on your discussion. So please manage your time very well and also be smart. All right, so we have more cash flow items, which is investments. Year one, minus 200. Year two will be slightly different. Year two will be equals to 0.64, as they told us, multiplied by the change in revenue. So this minus this. You have that, but remember, it's an outflow, so it has to be negative. Please take note, cash inflows, by now, you should know cash inflows is positive and cash outflow is negative. Once you have your investments, remember, financing activity is not relevant here. So you have a free cash flow item straight up. So for year one, you have 472, year 2, 3, 4, 607.8 to that. So that's our planning horizon, and we can get the PV of the planning of phase one, planning phase. Remember, in exam, you are allowed to use Excel for your PV. So I'm going to do this. WACC is equals to this place. So we need to calculate our WACC. And to calculate WACC, we need to calculate cost of debt, cost of equity of the combined company, then we can get our WACC. What we know for sure is that for this combined entity, they said the current annual growth rate, borrowing rate. So this RF, market premium given 7%, but we don't know the equity beta of the combined entities. There are two phases of growth of cash flow. There is this one is the initial phase, and after this one we have the perpetuity side, and I'm going to come to that. But before we can do any of that, we need to know our cost of capital, which in this question for the combined entity they did not give us. The 10% that I used earlier was for sure, which we cannot use it. So we need to calculate the WACC for the combined entity, which means after acquisition, what will be the cost of debt and what will be the cost of equity. That's what I want to work on now. Yeah, and from what we have in the question, the cost of debt looks pretty straightforward, but the cost of equity is not the same. So I can see that they actually told us that everything happening is after the acquisition, and they told us that the interest on borrowing will be 5.3%. So we know that 5.3% is the cost of debt, but we don't know what it's going to be for cost of equity. To get the cost of equity, we use a capital asset pricing model, looking at the information that they have given us here. We have everything except from beta. This is risk-free rate. Remember, if we use capital asset pricing model, it means that we need risk-free rate plus beta into bracket RM minus RF. RM minus RF is your market risk premium, so 7%. So beta is what we don't have, equity beta to be precise. So we need to calculate equity beta for the combined entity. Now, please pay very solid attention here. If you remember your Mondigliani-Miller formula for asset beta, it said asset beta is equals to VE divided by VE plus VD into bracket 1 minus T. All of that multiplied by BE, beta equity. It's the same formula we use whether we are calculating asset beta or equity beta. I just need to rearrange. Right. But this time around is equity beta we want to calculate because the capital structure is now 30/70. Yeah. 30/70. which is 30 debt, 70 equity. But the beta asset that we're going to be using has to be for the combined entity. We don't know it. We only know the asset beta for Chikepe and asset beta for Sure. For Sure has 0.95 and Chikepe has 0.8. Equity beta of each of them is not useful to us because they are different companies isolated. We cannot merge it like that because they have different capital structure. We need to focus on the business risk side of our beta, and that is 0.8 and 0.95. And they've told us clearly that for the combined entity, the asset beta has to be weighted using the value of equity. So, which means the combined asset beta we have Chikepe and we have For Sure. The asset beta is for Chikepe is 0.8 and this is for 0.95. Market value of equity of Chikepe is equals to, they gave us in the question, I think earlier as 12,600 here. Yeah, you can see it. So 12,600. And for this guy, we calculated it earlier on as 985. So if I add that together, because I need to get the proportion, So proportion is equals to that divided by the total. So 93%. So now I know the percentages, then I can wait to get the total combined asset beta. So which means this will be 93% of its asset beta, and this one will be 7% of the asset beta. Then the total asset beta is for the combined entity, which is equals to this plus this. So we know our combined asset beta to be 0.8109. So we know that for sure. But what we need is the equity beta, which we need to put in here. So if you rearrange this formula, top of my head, if I try to do this, so B will be equals to the same formula, I just rearranged it. Then I can now apply the formula now. So my B is equals to the combined asset beta of this multiplied by VE. My VE is the volume of equity, which is 70, plus VD is 30, multiplied by 1 minus T. They already told us tax is 20% for both companies. Then I need to close this bracket. All of that divided by volume of equity, which is 70. So, and I have my equity beta as 1.0889. Then easy to get our cost of equity because cost of equity is simply equals to RF, which is 2%. They already told us right here that the risk-free rate is at 2%. Yes, they give us here. So plus beta, which is this, multiplied by risk premium, they give us that to be 7%. So I'm going to put our cost of equity here. Then we need to get our proportion for each of the capital before we get the WACC. So what is the value we are talking about here? The value for KD is 30, K is 70, because that is, they gave us that 30/70. So which means WACC can now be equals to this multiplied by this. Let me make this 0.3 just to make it faster. Yeah, and this 0.7, 70%. WACC is the addition of the two. So WACC is actually coming to 8.33%. So once we know WACC, everything is easy. So instead of putting XX here now, I'll link it to my WACC straight away. And so I can have the planning phase present value. I hope that part is clear. I'm still building the value of the company. Remember, this is not the whole value. This is just the planning phase. All of this that we have done is for us to just be able to get the WACC of the company, which is what we'll use as cost of capital to discount. So now we know the present value of the cash flows that we know, but there's a cash flow that we don't know, which is the cash flow after year 4, from year 5 till eternity. But one thing we know is that this cash flow will grow at 607.8. We know that's what's going to happen. It will grow at 607. Sorry, this 607.8 will grow at 5.3%. Or what rate did they give us? They give us a rate. Yes, 5.6% rather. So if your cash flow will grow at 5.6% till eternity, perpetual, what will be the value as at the end of year 4? Remember, the cash flow you are talking about is a cash flow that will happen from year 5. And every cash flow is assumed to take place at the end of the year. So which means that cash flow will start from the end of year 5. So when you start to discount from end of the year 5 to future up to the beginning of year 5, that is end of year 4. So what you are saying is that whatever PV you get is at this point. So when you get that PV, then you still need to PV it again to bring it to year 0, where everybody is, because this is just partial discounting. So, but the first thing you need to do is to get the PV at this point. And how do you do that? So I'll
We use
call
the
this.
formula,
Which of the formula are we going to use?
the PV future value 1 plus R and then number of years.
Fantastic. Yes, we're going to use this same formula again because it's a growth to perpetuity. If it was not growing, what do you think we would have done? Anybody? If there was no growth, if they had told you that this cash flow of 607.8 would remain the same from year 5 till eternity, what difference would that make in terms of initial PV for that phase 2?
I think we would first use the annuity factor.
Not exactly.
And
I
then
think then it would be
Annuity
discount
the
it.
cash flow
annuity
divided by the
factor
cost of capital.
exactly. Remember, annuity factor will only work if you have a definitive constant cash. Yeah. So if it's a constant cash for some years, then annuity factor will work because you have a definitive years, 3 years, 4 years, 10 years, or whatever. But if it's a growth till eternity, if it's a constant cash flow till eternity, then it's just the cash flow divided by the cost of capital, right? But this one is now a growth till eternity, then your dividend model will have to come into play. Nice. If you use that, then you have easy thing to deal with. So you have this multiplied by the growth rate is given 1.56, 5.6. So that's 1 plus 5.6% divided by cost of capital. Our cost of capital is WACC minus growth rates. We know is 5.6%. And we can get our initial present value. So this present value you have here is the present value at this point, at the end of year 4. So which means you cannot stop there. You need to bring it to year 0, and that is the final PV. And in that case, you have a single cash flow at the end of year 4. You want to bring it to year 0. All you need to do is to just use your PV table and get your discount factor and multiply it. At 4 years, there may be 8.3%. But rather, because you are working on Excel, you can just do the calculations straight away And because you might be wondering, how do I check 8.3 on the table? You can use 8%. But rather, I would prefer you just work it out. Better you just work it out. So present value is this, multiplied by 1 plus R, which is your discounting factor, then raised to power minus 4. And that will give you your final PV. Okay, so this is the final PV for the phase 2. So which means the total, if I bring this down so that it doesn't, let me put this one here. Yeah. So the total value now, total firm value is now equals to the planning phase value plus the second phase value. And that gives you that total. But remember, what the question wants us to calculate is the equity value, not the total firm value. So can you tell me what the equity value will be? Anyone?
I think it will be 70% of that figure.
Thank you very much. Because it's 30/70. That's a capital structure. They told us that will remain 30/70. So 70% of that figure is actually the equity value of a combined entity, which is actually what the B is asking us to calculate. Once we've done that, we've dealt with question B. But the third one still wants us to go further. And the third one says that we should evaluate whether the acquisition of Foreshore will be beneficial to Chikepe shareholders and also discuss the limitations of the method. Yeah. We'll talk about the limitations, but first of all, we need to decide, does this make sense for Chikepe? The question is, how do we know whether it makes sense? Like I always say, it will only make sense if there's a value in it. But you don't just say if there's a value in it, you need to be able to quantify how much is this value we are talking about. Yeah, we're saying that after acquisition, the equity value is this. But before acquisition, what is the value of the companies separately? Yeah, before acquisition. Before acquisition, Chikepe was 12,600. For sure, right? We got for sure to be this. So which means before acquisition, if you add them together, both of them, they are giving us this figure, 13,585. That is what we have. So the question is, would this make sense for anybody to do if the after value is 13,212? Does this make sense?
No.
It does not make sense.
In the absence of real options, it doesn't make sense.
Exactly.
Okay,
Except,
I have a question to that.
Yes.
Yeah.
Yes.
When we answer that question, do we say no categorically? Because I have a feeling like, okay, financially it doesn't make sense. What about other synergies? Do we need to consider those?
Yeah. So if you look at this question, evaluate whether the acquisition of them is beneficial. So first of all, you start with the empirical data. That's first of all. One thing I need you to understand is a question like this can give you any type of answer and you will still be correct. Depends on how you've approached it. And let me give you a typical example. Assuming that someone has calculated work to be 8.33, okay? And has decided to say, I'm going to use my present value table, which means I'll just use 8% instead of 8.33. What it means is that this PV that we use 8.33%, that person would have used 8%. Watch me, I'm going to revert back for this. For this as well, this person would have used 8% here. Where did we use? This as well, it would have used 8%. You'll see something. What did you see to equity value? Just by using 8% instead of 8.33. Do you see how much this equity value has gone up? Can you see that it will be a different decision? Can you see that?
Yes, sir.
That is why it is important for you to understand what you are doing, because there is no one way to your answer, especially in a strategic paper. You just need to stay on your logic and go on with whatever you are doing. Just using 8% instead of 8.33 will make acquisition make sense. Whereas if you stick to your absolute data, go back to absolute data, yes, you will see that it does not make sense. And you have to actually conclude based on your data. So the first thing you say is, based on the calculation, the total value after synergy, after acquisition, so total value of combined entity is equals to this. This is what we have, 13214. So value from acquisition. Value from acquisition has to be the value after combination minus the value before. And here it gives negative. So we can't, it's not good. And that is what you have to say. So on this analysis, based on this analysis, it is not advisable for Chikepe to acquire for sure. Now, what you can now say is, however, beyond this data, looking at the fact that the synergy loss is narrowly negative because it's quite small, yeah, or even if it is even large negative, you can still say Chikepe might have other strategic reason why they want to go ahead. However, based on the analysis and the negative amount of synergy calculated, Chikepe should not go ahead with the acquisition. That is how you will say it, right? But like I said, it is very important for you to know that one decision is not always the final answer. Most important is that your logic must reflect your answer and your explanation. So let's talk about limitations. What are the limitations? Because this is where you have to actually also pay attention to the scenario. Yeah. So now, assessment of acquisition, you have to discuss it based on your output. Is negative synergy, so you advise that they shouldn't do it. But if yours gives positive, definitely you advise that they should do it. But like I said, if someone has used present value factor at 8%, yeah, you'll be positive. But if you work strictly on Excel, everything, it should be negative. But both of you will get your answer and your marks 100%. What are the limitations of the method? We've used method for discounting factor, which should be good, but however, it has its own issues based on the way we've approached it. And this is where you get some marks on professional skepticism when you start challenging some of the assumptions that have been made and all of that. Yeah. So, and those are your limitations that you'll be talking about. You remember that it gave us some information to use. Yeah. Which we struggled with. Some of them is beta. Beta, it gave us beta for each company, and we had to weight it to get the combined beta. So normally, when you have to calculate cost of equity using beta, one thing you know for sure is that beta is not always an easy data to get. So that's one limitation you need to note. Yeah. Difficulty getting beta. If you know how beta is gotten, then you realize that it's actually a long process. You have to get a long historical data, you plot a graph, then you do regression analysis to actually get beta of company. So naturally, anywhere you have to use beta, the disadvantage of that method is always difficulty in getting beta. Is always going to be valid. That's something to note. And likewise, they told us that the growth to perpetuity, yeah, growth to perpetuity, I'm sure you know that that is not given, it's a wish. Yeah, even if you plan to go to perpetuity, it's not always the reality. Yeah, it's not guaranteed. Always know that, but we have done our evaluation based on that. Yeah. Yeah, I said it's difficult in getting beta, yeah, especially the fact that this guy is unlisted. That comes to mind now. For sure, is even unlisted, so it even makes it more difficult. If for sure is unlisted, then it's even worse. So take note of that. Likewise, even the growth assumption of 5.6 also, we don't know the basis. 5.6 revenue growth and cash flow, revenue and cash flow. It says it will grow by 5.6 to eternity. That rate, yeah, is without assumption. Yeah, not given. And you don't know how realistic. So you can see here, you are challenging those assumptions, and that's where you earn even more marks on professional skepticism. So you are skeptical about those data. You have asked me to grow revenue by 5.6%. On what assumptions? You don't know, you don't have it. So this 5.6 is only as accurate as much as the assumptions are good, which you don't even have access to those assumptions, right? There's something as well that you notice. The initial, there was one growth rate that we did here. It's 3 and 98. That is an historical rate that we have used to project the future of valuation of Fossil. That is also a problem because you can, it's not that you can't use it, but you should know that it's not the best way. Using historical rates to project into future, that's also a problem. It's not advisable. So those are all your limitations. You can list them, but please make sure you link them. You can see we're picking them from the case. So actually, they are things that are relevant to the question. So once you finish, you need to conclude, and your conclusion will definitely come from your results and your assessment, which is the fact that, yeah, it looks that there are a lot of synergy opportunities, but in terms of data and the analysis that have been done, it doesn't look like this will add value to the shareholders because the synergy value is negative. However, if it was positive, it would have been a viable opportunity. But with the way it is, you cannot advise them to go forward with it. And that's it for that report. Then you can go to D and deal with D. They asked you to discuss how the mandatory bid rule and principle of equal treatment protects shareholders in the event of their company facing a takeover bid. This one I touched on it briefly when I was speaking. This is just talking about regulations trying to protect shareholders and the larger stakeholders actually when you are dealing with acquisition. And what they're trying to just do is to make sure that everybody is taken care of, not just the majority shareholders. So when you talk about the mandatory bid rule, yeah, mandatory bid rule, the focus of that is just to ensure that the minimum selling price that you pay minority shareholders is the recent price of share transaction. So take, for instance, if that share has been traded recently in the market at a particular price, you cannot buy the shares of the minority shareholders at any value less than that. Because like I said, the buyers are always pushed to focus on the majority shareholders because they just feel like those are the guys that matter. Whereas the minority shareholders, they don't have option. Once the shareholders that matters have agreed to sell, they will rather stick to it or they sell at any price they want to sell. And these are the reasons why the rules are coming in. So this is a rule that's saying that, okay, if this price of share was $10 yesterday and you are buying today, you can't buy less than $10 from the minority shareholders. Don't treat them like as if they don't have option. Yeah. So in summary, what I'm saying is that the minimum selling price should be the maximum recent price of the shares trade. Yeah. So whatever has been traded recently, the price that have been used will be the minimum selling price. So this minimum selling price for minority shareholders. Remember, these two laws are actually protecting the minority shareholders. And if you look at the other one, which is the principle of equal treatment, the name already say it all. It's just saying that the way you treat the majority shareholders, the same way you should treat the minority shareholders. So whatever you pay to the majority shareholders, whatever benefit you give to the majority shareholders, give it to minority shareholders. That's what this one is talking about. So whatever price or value or benefit you pay to majority shareholders, same must be paid to minority shareholders. So sometimes you pay to majority shareholders and you even promise them some contingent benefit. The same thing you must do to minority shareholders. The same way you treated them, you must treat all of them, not segregation. There is no separation of treatment. Yeah, even though shareholders are the ones that take the decisions, they are not any different from minority shareholders. That is what that particular rule is talking about. So that is it for this question.